To the panel that's before us, you have a lot at stake here. You have a lot at stake here because we are discussing banning yield spread premiums. We're discussing no-doc loans, prepayment penalties, teaser rates, securitized liability, on and on and on. I want to get right to the part of the bill that basically banned yield spread premiums. And I would like to start with, is it Mr. Rock? I can't see from here, yeah. I don't know if it was you who started to talk about how perhaps this is not the right thing to do, that you would be placed at great disadvantage. And I want to know, is that because you think that the requirements that we place on the banks for their employees will not match the requirements that we place on you relative to, number one, they need to be licensed, and number two, how they are paid or not paid for their loan originations?
No, I did not make any of those remarks that you're referring to, but just to comment on yield spread premiums, in most circumstances that I am familiar with where they're used, I think it's a bad practice.
Oh. Really? I'm sorry. He just reminded me that I'm really speaking to the brokers and not the bankers on this. So who would like to respond to that? Mr.
Sabat.
Okay.
That's me.
All right, Mr. Sabat.
Congresswoman, first of all, I think there's a great misconception about yield spread premiums. Yield spread premiums, and I've been a broker for over 25 years. Yield spread premiums are a very useful tool in helping a consumer, a borrower, get into a property with less money up front, less money for closing costs, less money for down payment. And these our brokers have been accused of using yield spread premiums as an incentive to make more money. And I think what people are failing to recognize is every time you raise your yield spread premium, you're raising your interest rate. If you raise your interest rate too high, you're not going to get that transaction. Somebody else, another originator, will get that transaction. And the fact that brokers do, depending upon who you talk to, anywhere between 50 and 70% of all the residential loans in this country, that tells you that brokers are not doing that. You may have some originators, not just brokers, but you may have some originators possibly abusing back-end fees, or whether it's a YSP or, of course, the lenders all get service release fees. We disclose this, incidentally. Nobody else in the market discloses it. We've been required by HUD since 1992 to disclose yield spread premiums on the good faith estimate and also on the HUD-1 settlement statement. So I'm sure you understand how frustrating it is for us with all of the news accounts that have come out over the past several months that brokers must disclose all of their fees up front. There's no mention about lenders doing this. And it's kind of ironic because brokers are the only ones who disclose their fees.
So if lenders had to disclose, would that make you feel better?
If lenders had to disclose, it would make it more transparent to the consumer. There would be less confusion. There's a couple of FTC studies that came out and said because brokers are the only channel of distribution that disclose yield spread premiums, the consumer is often confused into picking the more expensive transaction. He looks at where the broker lists the yield spread premium on the good faith estimate. He thinks that is an extra charge. The consumer thinks it's an extra charge when in fact it's not. When FTC conducted their study, they I forget how many people they actually had involved in the testing, but in most cases they purposely made the lender good faith estimate more expensive than the broker good faith estimate, but consumers more often than not picked the broker good faith estimate as the more expensive deal because they were confused by the that chart.
Let me just say this, and I've been one of the supporters of wanting to ban it, and I'm still not sure why we shouldn't ban the yield spread premiums. I hear what you're saying, but you haven't made the case why yield spread premiums allow you to assist the borrower more with the borrower paying less money. I don't get it.
Well, Congresswoman, I have a rate sheet here from the West Virginia Housing Development Fund. That's one of the states that I'm licensed in. This is a first-time home buyer program, a bond program. West Virginia, as Congresswoman Capito mentioned before, has the highest rate of home ownership in the country. They also have one of the lowest foreclosure rates in this country. We're ranked number 47th in the country, which we're all very proud of. Of course, even one foreclosure is one too many. But this is a government agency paying their lenders and brokers either a YSP or an SRP because they understand that this helps consumers become homeowners. Today, consumers have very little savings. They have very little money to get into a house. So by being able to use or take the benefits of a yield spread premium, it helps them become homeowners with less upfront costs for their down payment and closing costs. And as I mentioned before, lenders get the exact same thing, but they do not have the requirement to disclose.
I would just point out with respect to that point that the brokers, an essential difference is that the brokers hold themselves out as representing the buyer, whereas the lender does not hold themselves out that way.
In addition, there's a very different set of market disciplines on someone who works for a commission versus someone who lends their own money, and that's the key difference between...
Would the gentlewoman yield to me?
Yes, I yield to
Mr. Chairman, how does it help the consumer? How does paying a yield spread premium help the consumer? I guess I don't fully understand
First of all, Mr. Chairman, when a consumer calls shopping around for an interest rate, what they ask for is a 0-point rate, whether it's a broker or a lender. That's what they ask for. So we receive a yield spread premium for that rate, as a lender would receive a certain...
But it ends in a yield spread premium. Am I wrong that we're talking about your compensation? Who pays you the yield spread premium?
The lender.
The lender does.
Correct.
And what do you do to earn a yield spread premium from the lender?
We originate the loan, we process the loan, we prepare the loan.
But that's the basic thing. Where does the premium come in?
The premium is the difference between the wholesale and the retail rate.
So that the higher is it the case? What's the relationship between what the lender charges the consumer and the yield spread premium?
I'm not sure I follow your question.
Is there a relationship between the yield spread premium and the rate the lender charges the consumer?
There is, just the same as it is in an SRP. You have.
So the higher the higher the rate the lender charges, the higher the yield spread premium.
The higher the rate, the higher the yield spread, or the.
And explain to me how that helps the consumer.
I'm sorry.
Explain to me how that helps the consumer.
Because consumers all want, for the most part, 0 points loans. So if you take a lender and you take a broker, and let's say the interest rate for a 30-year fixed is 6.5%, they're both making the same amount on that loan. They're both being paid for that loan. When a lender originates a loan, and it's not just brokers that broker loans, when any originator...
You've lost me. Tell me how it helps me as a consumer if the person who I'm dealing with is going to make more money if I pay a higher interest rate.
Less upfront money. It's less money out of their pocket.
How?
And in some cases, it may pay for their closing costs.
Well, that's always the case, that the higher interest rate is always offsetting a lower closing costs and lower upfront?
Mr. Chairman,
is that always the case? That's a simple question. I'm skeptical of that. I'm skeptical that there's always that relationship.
Well, the consumer has a choice of paying points, too, if they want to.
No, but that's not the question. Is it never the case that everything else being equal, the higher the interest rate I'm charged, the more money the yield spread premium will be?
On any YSP or SRP, yes.
Okay. I don't see how that helps me. I mean, if everything else is being equal, you say 2 points, but that's,
Mr. Chairman, I can't stress enough that it does help consumers. And
how? If everything else being equal, the higher the interest rate, the higher the yield spread premium, how am I helped?
Because it's still a competitive rate that, regardless of who the originator is, it's still a competitive interest rate. And the benefit is...
No, you're missing my point. You say it's competitive, but it would have been lower. The broker... Does that not give the broker an incentive to find me a loan with a higher interest rate?
No, it doesn't, because the consumer always has a choice. We put options in front of the consumers. They always pick what's best for them.
And this does not incentivize the broker at all?
No, it's not. It's not. It's something that benefits the consumer. And again, we have a state housing agency that sees the...
Well, the fact that a government agency does something does not always immunize it, from the charge. I assume you would agree with that. Well, I've taken too much time. I'm so baffled.
Can I say one more thing?
Quickly. Gentlewoman's time.
Let me just say, because I know that you want to move on, that you have not made the case. And this is not what we understand as we have dealt with this issue. And so I'm looking for ways to really understand whether or not the consumer is disadvantaged, whether or not there is steering that would cause the originator to be able to make more money based on the higher priced product, and you're not helping us very much.
Congresswoman, I think there's a misconception. You're talking about the anti-steering provision in the bill. We're talking about two different things here. We're talking about YSP as indirect compensation, and we're talking about receiving extra compensation for steering somebody into a bill that into a loan that has no benefit for them. The National Association of Mortgage Brokers agrees with what you have in the bill as far as banning additional compensation, but we want to make sure that it is not being construed as our normal indirect compensation. This is something that is an additional amount of money, because whether it's if it's a 0-point loan, and this is the easiest way I can describe this, if it's a 0-point loan, regardless of who the originator is, whether it is a mortgage broker, a bank, a mortgage banker, lender, whoever it happens to be, everybody gets money on the back end of that loan if it is a 0-point loan. That's where they receive their compensation. It's indirect compensation.
Well, let me just say that under Section 103, our anti-steering section provides that no mortgage originator can receive and no person can pay any incentive compensation, including yield spread premiums, that is based on or varies with the terms of a mortgage loan.
But that should not be construed as indirect compensation for a broker. We're talking about, in that provision, we're talking about additional compensation for steering somebody to a certain type of loan. That's not what we're talking about. When brokers are trying to protect the yield spread premium, it is indirect compensation. It does definitely provide a benefit to the consumer, just like a lender receives a service release premium for doing the exact same loan. The only difference is we disclose that. The consumer has full disclosure at the time of application and also at the time of closing.